Every country on Earth is in debt. The US owes over $38 trillion. The entire planet owes a staggering $315 trillion. But wait a minute. If every country owes money, who exactly is everyone in debt to? The answer isn't another country or a far-off planet. The answer will completely change how you see money, power, and the entire global financial system. What if I told you this wasn't an accident, that this mountain of inescapable debt was engineered by design over centuries? This isn't a conspiracy theory. We are going to walk through the documented history, using public records and historical accounts to show you exactly how a handful of brilliant and perhaps ruthless individuals built the system we live in today, a system where debt can never truly be repaid. Our story begins over 300 years ago in 1694. England was broke, exhausted from a long war with France. The government desperately needed money. Enter a Scottish banker named William Paterson. He had a revolutionary idea. He proposed creating a private bank, the Bank of England, that would lend the government money. But here's the genius, or the trap, depending on your perspective. The government didn't have to repay the principal amount. They only had to pay interest on the loan forever. With the stroke of a pen and the signing of the Bank of England's Royal Charter, the concept of permanent national debt was born. For the first time in history, a government was legally bound to a perpetual interest payment to a private institution. The debt itself became a permanent fixture of the state, and the interest payments became a reliable stream of income for the bank's private shareholders. This single innovation laid the foundation for everything that was to come. Fast forward about a century to the Napoleonic Wars. This is where the Rothschild family, and specifically Nathan Meyer Rothschild, enters our story. Nathan was a financial mastermind. He didn't just deal in gold or commodities. He mastered the market for government debt known as bonds. He understood something profound. A government bond is only as good as the government's ability to pay its interest. His most famous move came after the Battle of Waterloo in 1815. Using a network of couriers, he received news of Napoleon's defeat a full day before the British government. But instead of buying up British bonds, he started selling them. The market panicked, thinking he knew Britain had lost. The value of British government bonds plummeted. Then, just before the official news arrived, he secretly bought up the entire market for pennies on the pound. When the news of victory finally broke, the bonds skyrocketed in value, and he made an unimaginable fortune. But his real innovation was more subtle. By creating a massive liquid market for government bonds, he made it easier than ever for governments to borrow huge sums of money. More importantly, he established the principle that even if a government changed hands or a king was overthrown, the nation's debt obligations would be honored by the next regime. He made sovereign debt an almost sacred, unbreakable promise. This made lending to governments safer for investors, which in turn made it easier for governments to sink deeper and deeper into debt. Default was no longer a viable option. It was becoming mathematically impossible without crashing the entire system. Now let's jump across the Atlantic to the early 20th century. The United States was a rising economic power, but it lacked a central bank. The banking system was chaotic, prone to panics and collapses. In November 1910, a group of the most powerful men in American finance, including Senator Nelson Aldrich and representatives from the empires of J.P. Morgan Rockefeller and Kuhn, Loeb & Co., held a top-secret meeting on a remote island off the coast of Georgia. The location? Jekyll Island. Their goal was to design a new central banking system for America. The plan they hatched over 10 days of secret deliberations would eventually become the Federal Reserve Act of 1913. Officially, the Federal Reserve was created to stabilize the banking system and manage the money supply. But one of its core functions, as designed on Jekyll Island, was to act as the primary buyer of U.S. government debt. Think about it. The government needs to spend more money than it collects in taxes. So, the Treasury issues bonds. Who buys a huge portion of those bonds? The Federal Reserve. And how does the Fed pay for them? By creating new money out of thin air. This created a seemingly infinite loop. The government could now borrow limitless amounts of money because its own central bank could always be counted on to fund the debt. The very system that was supposed to prevent financial chaos now enabled the government to accumulate debt on a scale never before imagined. The Jekyll Island meeting wasn't just about banking reform, it was about unlocking the door to infinite government borrowing. This brings us to the modern era, and the final piece of the puzzle, the 1970s and 80s. Many developing nations in Latin America, Africa, and Asia had borrowed heavily from large international banks. But in 1979, the U.S. Federal Reserve, under Chairman Paul Volcker, dramatically raised interest rates to fight inflation at home. This Volcker shock had a devastating global impact. Suddenly, the interest payments on those developing world loans skyrocketed, pushing dozens of countries to the brink of default. This is when the International Monetary Fund, or IMF, stepped in. The solution wasn't to forgive the debt. Instead, the IMF offered new loans, but with strict conditions. These were called structural adjustment programs. In exchange for bailout money to pay their old creditors, these countries had to agree to cut public spending, privatize state-owned industries, and open their markets to foreign corporations. The effect was profound. These nations became trapped in a cycle. They had to take on new debt just to pay the interest on their old debt. The conditions of the loans often made it harder for their economies to grow, ensuring they would remain dependent on future loans. Paul Volcker's policy and the subsequent IMF restructuring created a mechanism that funneled wealth from the developing world back to the large international banks. It solidified the global debt hierarchy, trapping entire nations in a state of permanent financial servitude. So, let's put it all together. The Bank of England created perpetual government debt. The Rothschilds created a global market that made this debt inescapable. The Federal Reserve created a mechanism for a government to borrow infinite amounts of money, and the IMF created a system to enforce this debt structure on the entire developing world. Who is owed the $315 trillion? It's not a single person or country. The debt is owed to a complex web of institutions and individuals who own these government bonds. This includes central banks like the Fed, massive commercial banks, investment funds, insurance companies, foreign governments, and wealthy private investors. Every year, governments collect taxes from you, the taxpayer. A huge chunk of that money, over $1 trillion annually in the US alone, doesn't go to building roads or schools. It goes directly to paying interest on the national debt. It is a direct transfer of wealth from the general population to the bondholders, the owners of the debt. This is why the US national debt of $38 trillion can never be paid off. Our entire money supply is based on this debt. If the government were to pay it all back, the bonds held by the Federal Reserve would be retired, and the money associated with them would essentially vanish from the system, causing a catastrophic economic collapse. The system isn't broken. It's working exactly as it was designed to. It was engineered over centuries to ensure that debt only grows, that interest is always paid, and that wealth is continuously transferred from the many to the few who own the debt. This is the documented, publicly recorded reality of our global financial system. It was built by design, not by accident. And understanding that is the first step to imagining something different. Thank you for watching. If this video changed how you see the world, make sure to subscribe and hit the notification bell for more content that challenges the way we think. See you in the next one.